Hey guys, welcome to section 11, where we're going to be talking all about stockholders' equity. And we have talked about stockholders' equity before in other sections of this course. But in this section, we're going to dive a little bit deeper into what stockholder equity is, how do we report that, which we might already know by looking at other journal entries that we did in other sections, and then some of the nuances with stockholders equity. Now, in this lesson specifically, we're going to give you kind of a foundational understanding of corporations. So we're going to look at some of the corporation operation things that you should know, specifically when it comes to equity financing. We will dip a little bit into the debt financing part, but we want to really help you understand kind of the basics of corporations from an equity funding standpoint. So let's get started here with understanding our corporate ownership. So kind of understanding a corporation. So how does a corporation kind of start? Well, we've got these shareholders, otherwise known as owners, but in the corporation world, we call them shareholders because they're going to hold something called shares. They're holding the shares, shareholders. So we've got these shareholders, and what they do is they're going to elect a board of directors. So the board of directors are usually shareholders themselves. So they are a function of shareholders. We would literally pick a board of directors from the shareholders. And the board of directors' job is to kind of help steer and operate the company. Not directly, indirectly, of course, because we're going to have professional managers manage it from a everyday standpoint, a direct standpoint. So we have this corporation. So we've got shareholders, and then we've got these board of directors, and then the board of directors hires the president and CEO, and then that president and CEO then hires their own helpers in the form of professional managers. So that's kind of the hierarchy of what happens in a corporation, a formal corporation. Now, some advantages to having a corporation are ownership is typically transferable simply by selling your ownership shares. So unlike a sole proprietorship or even a partnership, a corporation is made up of shares. And so if you own a share, you can transfer your ownership to someone else just by simply selling your shares. Whereas if you are a sole proprietor, in order to transfer ownership, you would have to sell the business. It's a little bit more involved. And we compared this to what that would look like versus if you owned a share of McDonald's, right? If you wanted to not own McDonald's, all you'd have to do is go to your brokerage account, sell your shares, and then you're done. But if you were to sell your business, it would be a lot of paperwork. You would have to find people to buy your business. You would need some attorneys. And the process would take days, weeks, months to sell, versus a corporation. You can do it within a matter of seconds. And again, we're talking about public corporations. If it's a private corporation or private type of corporation, then that would be a little bit more involved as well. But same idea of selling shares to someone else in a private corporation. So a little bit easier to transfer ownerships in a corporation just by selling shares. Now, corporations are separate entities from their shareholders. So an advantage of this is that shareholders are not liable for the company's debts or legal issues, assuming that we haven't pierced the corporate veil. What do we mean by piercing the corporate veil? We mean that corporations have this corporate veil over it, which gives them the autonomy of being their own person from a tax perspective. But if you don't follow the rules of a corporation, we can, or lawyers can, in the court of law, pierce the corporate veil, therefore taking off that corporate cover, and then now people that own it are now liable for the liabilities and the legal issues of that corporation. So there is some structure in corporations and you need to follow them, because if you don't follow them, you're going to pierce that corporate veil. And the whole reason of being a corporation is so that you have that corporate veil. So again, this is one of the advantages of corporation, is that if something happens to the corporation, it can't come and bite necessarily that shareholder. The only thing that the shareholder loses is their investment in the company. So a great advantage of a corporation versus a sole proprietorship. The other one is that if done correctly, shares can be affordable to individuals who want to invest in the company. So if you think about buying a business, it would take maybe tens, if not hundreds to millions of dollars to be able to buy it. However, that's different with a corporation in that a corporation, if you have your shares low enough, you can actually sell your shares to someone else, and that would be affordable to them because the share price would be lower than buying the entire business. So thinking about some of the biggest names out there like Microsoft, even Google, their share prices are significantly smaller than what they're actually worth and what you would actually have to pay to take full ownership of those corporations. So that's a great way of spurring interest in your corporation, because the price is at a lower price point that more people can afford. Now, common stock is generally the mechanism that we use to establish ownership within a corporation. And so we have these common shares or stock that is traded among the company and the shareholders, and then the shareholders between themselves to establish ownership. So the mechanism that we use for ownership is common stock, or stock for short, in the transaction of a corporation. Now, some typical benefits. So why do you want to be a shareholder? Well, these are some of the benefits of being a shareholder. So these are things that usually come with being an owner of a company. Now, I say usually because nowadays it's being stripped more and more, so you get less of these. But I will point out the two that are more part of ownership when you buy a share in a company. So the first one here is dividends. So this is kind of what shareholders expect for the most part. Again, some companies don't pay dividends at all, like Berkshire Hathaway, but that's fine. So shareholders can participate in the distribution of a corporation's profit, also known as dividends. So if you're a shareholder, you get to participate in the distribution of profits. Now, not every company is required, no company is required, but companies are not obligated to pay a dividend, but if they do, you as a shareholder would get that. Now, there are some reasons why companies will not pay a dividend, and that's because maybe they want to keep capital to invest it, or they believe that the funds are better suited in the company rather than in the shareholder's hand. So there's a lot of different reasons for this, but if a dividend was paid, you as a shareholder would get a portion of it. You can participate in it. The second benefit of owning a share, or that comes with a share, is that you have a residual claim clause. If a company ever ceases operations, common shareholders share in the assets left after all liabilities are paid. Now, this one really is not a benefit, and the reason why is you will not see a company at the height of success deciding to cease operations. If you do, great. But most companies will cease operations when they're not doing so good, meaning that they have more liabilities than they have assets to pay those liabilities. Therefore, they go bankrupt and then they cease operation. And so in those cases, all of that asset would be liquidated into cash and paid to debt holders. Now, there won't be enough in that liquidation, and so there won't be anything left for shareholders like you. And what this basically says is that if a company were to cease operations, any leftover cash or assets could be distributed to the shareholders in proportion to their ownership. But again, a company only ceases really operation when they are at their lowest, not necessarily at the highest. So I don't like to think of this as a benefit, but this is technically a benefit. The third type of benefit that common shareholders get is the preemptive right. The preemptive right says that owners may be given first right of refusal in newly issued stock to keep their ownership percentage the same. What this means is that as a common shareholder, if you purchased 15% of a company and the company decides we need to issue more shares, before they can issue more shares to the public, they should come to you first and say, hey, we are issuing more shares. Do you want to buy more shares in order to keep your 15% ownership? And you have the right of first refusal. You can say, yes, I will buy them so that I can keep my 15%, or no, go ahead and sell them knowing that you're going to dilute your 15% to maybe 14% because they're going to sell more shares that equivalent to 1% of your ownership. So this is a right that a common shareholder would get. And the last benefit here is the voting rights. Corporations do have things to vote on from the shareholders, and owners may be given the ability to vote on corporate actions, including shareholder action. So in those cases, if you owned a share, you would get a vote equivalent to what that share would be worth. Usually it's one vote, one share. So for every share you have, you get one vote. Now, a couple of things about this is these are the typical common stock benefits that you would get by owning a share in a company. But in all honesty, nowadays, you're seeing a lot of these stripped away, and really you're left with just the financial benefits of owning the company rather than all of these benefits. So if I walk you through this, dividends is an obvious given. Usually, if you have a share, I say usually, but usually if you are a common shareholder, you're going to participate in dividends. There's just no way around that. Residual claim, again, like I said, doesn't really happen. And the reason why it doesn't really happen is companies don't liquidate themselves at the height of success. They liquidate themselves at the lowest of success, I guess. Preemptive rights, typically this is not written out of common stockholder benefits. And the reason why is now we're in a economy where there could be tens, if not hundreds of thousands of shareholders, and just the cost of administering a preemptive right would be more than the benefit that they would get. So just think that if you were a shareholder of McDonald's, you would have to contact every McDonald's shareholder and say, hey, you own 0.000001% of the company. Do you want to buy one share in order to keep your 0.000001 of a percent? And the answer, from a practical standpoint, I don't want to have to call 10,000 shareholders or 20,000 shareholders to say, hey, do you want to keep your 0.00001 percentage ownership in us because we're going to issue more shares? So that's often being written off only specifically because it's just not, the cost and benefits don't match up. So that's typically not a case nowadays, but there probably is some common stock that does have this rule. Not usually a public company on a national stock exchange. And then the voting rights, a lot of this you'll see in a minute is being written off, and the reason why is you got a lot of these tech companies that want the owner to have more rights but also give up profit rights. We'll get to that in a minute, but that is often a part of common stock, but a lot of these new tech companies are changing the way voting rights happens when it comes to stock ownership. So those are the benefits of a common shareholders, and just specifically talking you through all of these. Now, ownership today. So when we said, voting rights are part of common stock, it's a little bit different nowadays because we don't necessarily have common stock. We more like have these classes of shares. So today companies have many classes of stock with a variety of rights. And these are two examples that I would use to help you understand that voting rights not necessarily used to be what they were. So for a company like Google or Alphabet, that's their corporate name, Alphabet Inc., you notice that they have a Class A share. With a Class A share, you participate in the profits, but you only get one voting right for every share that you own, which is typical. That's a typical common stock. Then they issued Class B. A Class B has 10 voting rights. So those 10 voting rights, those Class Bs, are only available to those executives, those founders of the company. Why? Because they want to keep control of their company, but they also need to be able to raise capital. And so to raise capital, they have to give up ownership, technically. So if you think about it, don't look at Class C, but your options were, I've got this Class A with one voting right, and now I have this Class B with 10 voting rights. I can still get capital by issuing Class A, giving up one share, but that's really not going to help someone because we're going to keep Class B, which has 10 voting rights, which will be more than 50% of the voting population, right? So they're getting 10 rights instead of one rights. And by doing that, you're able to basically continue running the company like the way that you want to, but still give up ownership in the form of financial benefits that a shareholder would get. So that's kind of what has been happening. And then Google is one of the first ones to actually put out a Class C, and a Class C has no voting rights. Now, if you go in the national exchange, you can buy an A or a C. You cannot buy a B because that's transferred significantly to the owners. And one of the rules about the Class B is once that owner sells it outside of their circle, basically, it turns into like a Class A or a Class C. And so you couldn't ever get a Class B if you wanted to, because once it's sold, it becomes a Class A or a C. But anyways, so we've got this Class C that has no voting rights. You can actually trade Class A and C on the National Stock Exchange, and you'll notice that there is a little bit of a price difference between the two. It's very marginal, but that marginal difference most likely is due to the worth of that voting right. And most people don't view the voting right as worth much, especially at a company where your executives have Class B shares. And so therefore the difference is very small. So that's the type for Alphabet and Google. For Facebook, they also are on the same track. So for Facebook, they've got a Class A share. They also have a Class B share that Mark Zuckerberg owns. Mark Zuckerberg, the owner and founder of Facebook, he has 10 voting rights for every one Class B share that he has. They did think about releasing a Class C. They never did because of backlash from their investors. So they have a Class A and a B. So we're getting all of these different classes as a way to manipulate, I guess you would say, the system. All right. So how do we fund a corporation? Well, there's two ways that we can fund a corporation. The first way we can fund it is what we've been talking about since the beginning of this lesson, and that is equity financing, where we sell shares to the public or to other people and they give us money. They now own a part of the company and we would take their resources and run our corporation. This also is the same thing that an owner, a founder would do, is by putting my own money into my own corporation to get it started. That's also called equity financing because there's no thought that I would get paid back. Now you might say that, but if the business goes down, your business is not going to pay you back. So even if you think your business is going to pay you back, you should always believe that it will never pay you back. So equity financing. We also have another option, and that is debt financing. Now, this is an option to some companies, but not to everyone else. So for instance, if I thought, hey, I'm going to start this cool YouTube business, for instance, and I'm going to go to the bank and borrow $100,000 so I can get all the equipment that I need to start this YouTube business. The first thing that's going to happen when I walk into the loan officer's office and want an application for a business loan for $100,000 is I'm going to be shown the door out because there is no way they are letting me have $100,000 to start a business that doesn't have any known revenue. So it's kind of like debt financing is an option, but it really isn't an option for those starting a business from the ground up. So it becomes an equity finance. It becomes an owner finance type of, owner equity financing type of business. So I hesitate to say that debt financing is an option because it really isn't an option if you're just starting. Now, you might be doing something a little differently where you might have some resources and you can debt finance it, or if you personally guarantee it. But usually that's not an option for a lot of people. Now, let's run through these equity and debt financing just so that you understand them at a greater level. So equity financing, equity doesn't need to be repaid. So that's why we call it equity rather than debt. Debt financing does need to be paid back. The thing about debt financing is that interest on the debt is tax deductible. So that's a good thing about debt financing is you can write off the interest that you pay on the loans. Now with equity financing, dividends are optional. So the great thing is that once you have the money, you don't have any obligations to pay back your shareholders, but dividends are not tax deductible, so you can't write off dividends paid to shareholders. Now, with debt financing, the great thing about debt financing is if you debt finance it, you're not bringing in any more shareholders. If you're not bringing in any more shareholders, you're not diluting your ownership percentage in the company. Now, companies should choose the best funding mechanism that will help them achieve their objectives appropriately, or that they can get a freaking loan for at the end of the day, right? So if they can't get a loan, they're going to have to use equity financing resources to be able to fund their business. And there are some good reasons why equity financing is better than debt, and most of the biggest reason is that you have you don't have to pay back anything, and the leverage, you don't have that risk of being too leveraged, and too leverage means that you have too much debt. To leverage, so that if a downturn of the economy did occur, you could still just ride it out because you don't have to pay the bank anything, or interest or principal or anything. So you can just ride it out, and then when the economy starts going back up, your business has already been there because it didn't have to worry about having to make those loan payments to the bank. So choosing the best one that works for you. So that is our lesson here on corporate ownership. We're really talking about some of the basics of corporate ownership, specifically common shares, because that's what we're going to be working a lot with in this section. So I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and I'll take you to that video. So until then, we'll see you in the next lesson.